Stock market or real estate, who wins? Spoiler, it's not even close. The S&P 500 crushes real estate in long-term returns, but real estate has secret weapons like tax breaks and leverage. The truth? It depends on your risk tolerance and how hands-on you want to be. Let's dive into the data. The numbers don't lie. Since 1926, the S&P 500 averaged 10.24% annually with dividends reinvested. Real estate? Just 5.5% in appreciation. That difference turns $10K into $174K in stocks versus $49K in real estate over 30 years. The stock market isn't smooth sailing though. Yes, stocks crash harder, like 2008's 37% drop, but real estate isn't risk-free. Local markets can stall for decades. Detroit still hasn't recovered from 2006. Over every 20-year period in history, stocks have still come out ahead. Even in the lost decade of 2000 to 2010 when the market went nowhere, reinvested dividends kept returns positive. Most people don't account for reinvested dividends. The S&P 500's return drops to just 6.5% without them. That's the hidden engine making stocks crush real estate long-term. A $500 monthly investment with dividends grows to $1.2 million in 30 years at 10.24%. Without dividends, just $530,000. The S&P 500 wins in pure returns, but real estate has an ace up its sleeve: leverage. Putting 20% down means a 5% price increase becomes a 25% return on your money. Leverage is what makes real estate investing fundamentally different from stocks. Here's where it gets spicy. Put 20% down on a $250K property, and you control the full asset while only risking $50,000. If that property appreciates 5% to $262,500, your $12,500 gain equals a 25% return on your cash. That same $50,000 invested in index funds at 10% only grows to $55,000 in year one. The math looks great until it doesn't. In 2008, one investor's $100K vanished when the home dropped 30%. Stocks dropped too, but didn't demand another dime. That's the risk difference. Banks don't demand more money when your real estate loses value if you keep making payments. Concentration risk is real. Real estate is concentrated. One property, one market. Index funds give you 500+ companies. And liquidity? Stocks sell in seconds. Homes take months. The bottom line? Leverage supercharges real estate returns when markets rise, but losses hit harder than index funds during downturns. Now let's talk about what happens when you actually need to access your money. Selling stocks takes seconds and costs nothing. Selling rental property? Passive income from real estate isn't as passive as it sounds. Passive income? Try leaky roofs at 2 a.m., property management, repairs, taxes, it's work. Index funds run on autopilot, rental properties demand constant attention, tenants trashing your place, legal nightmares, renovation costs. With index funds, your assets don't text you at midnight. Real estate has tax perks, sure, depreciation, mortgage write-offs. But come sale time, you're hit with depreciation recapture and capital gains. Index funds, one tax at sale. Liquidity matters when life happens. The verdict? Real estate builds wealth with leverage and control, but demands time, risk tolerance, and stress. Index funds? Autopilot wealth. For most people, the S&P 500 is the better fit long-term. So which path wins? For true passive wealth building, index funds clearly outperform real estate long-term costs and effort. The SP's 10% historical returns beat real estate's 5.5% appreciation, and you avoid landlord headaches. But if you enjoy hands-on work, real estate offers leverage and tax benefits index funds can't match. You decide. If you found this helpful, smash that like button and subscribe for more breakdowns that actually use numbers. Which do you prefer, stocks or real estate? Drop it in the comments.